Imagine finally selling your business, right? Like your life's work. You sell it for £5 million.
Yeah, you pop the champagne, you celebrate.
Exactly. You celebrate, and then you check your bank account, only to realize your accountant structured the deal so poorly that the tax man just legally took an extra million out of your pocket.
Which is brutal. But it happens all the time.
Welcome to today's deep dive. Our mission today is unpacking exactly what an accountant actually does when you sell your business. We're looking at why the person who, flawlessly files your taxes every single year might actually be the exact wrong person to manage the sale of your company.
Yeah, getting this specific choice right is literally the difference between a lucrative, life-changing exit and just a highly stressful financial collapse. It's arguably one of the most misunderstood areas of business acquisition.
Right, because the prevailing assumption is just that an accountant is an accountant, right?
Exactly. But expecting a general practitioner to understand the intricacies of complex tax restructuring during an acquisition, well, it's a massive, costly mistake.
Which is exactly why we're trying something a little different for this deep dive. We're doing a bit of a role play.
I love this idea.
Yeah, so for the next little while, I'm stepping into the shoes of a UK business owner.
Yeah?
I've built up my company, I'm preparing to sell it, and I am fully assuming my trusty, regular accountant will just handle everything seamlessly.
And I'll be playing the role of the seasoned mergers and acquisitions advisor. I'm here to gently guide you, and you, listening through the actual reality of an acquisition.
Awesome. Okay, let's unpack this. I've been with my accountant for a decade. They're fantastic. They do my year-end accounts perfectly. They never miss a deadline.
Right, they keep the tax man off your back.
Exactly. They know every single penny that comes in and out of my business. So why on earth would I need to bring in a stranger for this sale? Isn't that like asking my GP to perform brain surgery, or can they actually handle it?
Look, your regular accountant is absolutely brilliant for compliance. I mean, they make sure you pay the correct amount of tax, that everything is filed with precision, all of that. And they make sure your day-to-day operations are legally sound. But selling a business requires a highly specific, highly technical set of M&A skills.
But numbers are numbers, aren't they? Like profit is profit.
Not exactly. What's fascinating here is that a general accountant will often look at a business and value it strictly based on what the balance sheet says.
Okay.
This is known as net book value. It's essentially taking your physical assets and deducting your liabilities. But in the M&A world, that completely misses the reality of a transaction.
How so?
Well, a business isn't just worth its desks, its laptops, and its inventory, It's worth what a buyer is willing to pay based on profit multiples and the expectation of future cash flow.
So if I rely solely on my regular account, they might look at my business, see 50 grand in physical assets, and anchor my expectations to that.
Yes, exactly.
Totally ignoring the fact that I generate, I don't know, $500,000 in profit every year.
Precisely. And honestly, it gets worse. Generalists can actually kill a deal inadvertently. Because they don't do this every day, they often give sellers overly conservative or purely book-based advice.
Like telling me a buyer's offer is bad just because it's structured weirdly?
Yeah, they might tell you a buyer's offer is completely wrong because it involves complex equity structures they just aren't familiar with. Meanwhile, an M&A accountant understands deal structures, working capital negotiations, market trends.
They speak the language.
Right, they speak the specific language of the transaction.
Okay, so to use an analogy, my regular accountant tells me what my car is worth if we sold it for scrap metal and spare parts.
Okay, yeah.
But an M&A accountant knows how to position and sell that exact same vehicle as a classic high-demand collectible on the open market.
That is a brilliant way to look at it. The M&A accountant is looking at the market value of the operating machine, not just the sum of its static parts.
I can see the value in that, but honestly, won't bringing in a new M&A accountant completely offend my current one?
Oh, I hear this all the time.
Yeah, I mean, I don't want to ruin a 10-year relationship with the person who has kept my business afloat just because I'm selling.
You really don't have to ruin the relationship at all. It's about building a deal team of specialists. You keep your regular accountant for the day-to-day running of the business while the sale is happening.
Which I assume is a full-time job in itself.
It absolutely is. And you bring in the M&A specialist specifically to handle the transaction. Good generalist accountants actually appreciate this, believe it or not.
Really? Why?
Because they know M&A involves complex competition, regulatory, and tax considerations that carry massive liability. And it's liability they simply don't face in their day-to-day practice.
All right, I'll buy that. I need a specialist. So let's say I hired this M&A accountant. what do they actually do before my business ever hits the market?
Well, what do you think they do?
Because my assumption is they just sit back, wait for a buyer to show up, and then answer the buyer's questions.
If you wait for the buyer to ask questions, you have already lost control of the narrative. Your M&A accountant's very first job is to aggressively review your last 3 years of accounts before a buyer ever sees them.
Okay.
They are looking for anything that needs explaining, adjusting, or tidying up to present the business in the absolute best financial light.
Wait, if my accounts are already fully compliant and legal, what needs tidying up? Are we talking about changing the numbers?
No, we aren't changing the reality of the business, we are translating it. This brings us to a critical concept in business sales called normalization,
Normalization.
or calculating the add-backs. You see, in a private business, the owner's personal life and the business's finances are often intertwined. The goal of normalization is to adjust the profit figure to reflect the true underlying earnings of the business.
So stripping away my personal lifestyle choices.
Exactly. Completely stripping them away.
Let me push back on this. If I'm running personal expenses through the business, let's say I lease a Range Rover through the company for my wife, and I expense my mobile phone. Sure. If the M&A accountant just pretends I didn't spend that money and adds it back to the profit column, isn't that just cooking the books to make the profit look artificially higher to the buyer?
I can entirely see why it feels that way, but it's the exact opposite. It's about radical transparency. The corporate buyer who acquires your company is not going to be paying for your wife's Range Rover or your personal mobile phone.
Well, no, of course not.
Right. Those are expenses unique to you as the current owner. The buyer needs to know the true underlying cash-generating power of the core business, completely independent of your lifestyle.
Oh, I see.
So we add that money back to the profit line to say, look, if you run this efficiently without the owner's personal perks, here's what the business actually makes.
So basically, I've been intentionally suppressing my profit for years to lower my corporate tax bill, but now I need to reverse that logic so the buyer sees the real engine underneath.
Exactly. And it goes way beyond carve. Maybe you pay yourself a salary that is wildly above the standard market rate for a CEO in your industry. Or maybe it's significantly below.
Oh, true. Or perhaps last year you had a massive one-off legal fee for a trademark dispute that will never happen again. An M&A accountant normalizes all of that. They adjust the profit to show the true recurring revenue.
That makes perfect sense. It's isolating the engine's true performance from all the heavy luggage I've been carrying in the trunk.
Yes. Great way to put it.
Okay, so the numbers are normalized. We go to market. We find a buyer. Now, I know from running my own business that time kills all deals.
It really does.
If things drag on, people get cold feet. How does this M&A accountant keep things moving?
Momentum is absolutely everything in a sale. And the biggest deal killer is waiting for a seller's accountant to meticulously prepare full, formalized statutory accounts every single time the buyer asks for a financial update.
Yeah, that sounds slow.
It is. A generalist might take 3 weeks to draft perfectly formatted management accounts, and by the time they deliver it, the buyer has lost interest or gotten suspicious.
So what's the alternative? Don't the buyers want those polished PDFs? Buyers want proof, not polish. A seasoned M&A accountant knows how to instantly provide documentation that is easy to access, requires absolutely no new work, and proves the health of the business immediately.
Like what kind of documentation?
We're talking about handing over the last 12 months of VAT returns, recent corporation tax returns, and simple bank statement downloads.
Wait, really? Why those specifically? If I just hand over raw bank statements and tax returns, doesn't that look disorganized?
It looks undeniably authentic. Think about it from the buyer's perspective. Anyone can manipulate a spreadsheet or draft a rosy set of management accounts.
Fair point.
But VAT returns show actual historical sales and expenses submitted to the government. Corporation tax returns instantly prove the historical profit that has been declared.
And the bank statements.
They prove the cash is actually flowing in and out exactly as you claim. You provide those 3 things on day 1, and you establish instant trust and keep the momentum alive.
Fast and undeniable. I like that. But here's a structural thought. Why can't I just act as the middleman for all this?
What do you mean?
Well, I'm the owner. I know my business best, and frankly, I like controlling the flow of information to the buyer. I don't want my accountant and their accountant whispering behind my back.
That is a very common instinct for business owners. You're used to being in control. But think about what happens when complex financial queries are routed through someone who isn't a technical financial expert.
I suppose it's like a highly stressful game of telephone. I'll get asked a tax question, try to translate it to my accountant, misunderstand their answer, and then relay a mangled version back to the buyer.
Exactly. And that mangled version causes the buyer's accountant to panic and flag a massive risk to their client. It is wildly inefficient, and it just breeds mistrust.
So direct contact is better.
Direct accountant-to-accountant dialogue is fast, it's technically precise, and crucially, it strips all the emotion and ego out of the negotiation. If the buyer's accountant challenges a valuation metric, your M&A accountant defends it clinically.
Whereas if I try to defend it, I take it personally because it's my life's work.
Spot on. You take it personally and the deal derails.
Okay, so the accountants are talking directly, keeping the emotion out of it. And that leads us into what sounds like the scariest phase of this whole process. Here's where it gets really interesting.
Financial due diligence.
Yes. Now, if my regular accountant has been filing my taxes legally all these years, what is there for the buyer's due diligence team to actually find? Are they just double-checking the math, or is there a bigger threat?
They are definitely not just double-checking the math. The difference between day-to-day accounting and due diligence is the fundamental objective.
How so?
Day-to-day accounting generally relies on what the owner reports to the accountant. Due diligence actively hunts for what the owner forgot to report or what the day-to-day accountant didn't realize was a liability.
So they're essentially auditing my business's skeleton closet. What exactly are they looking for?
First, they're going to stress test your quality of earnings, or QOE. They want to see if your stated income is truly due to higher sales and solid margins, or if it's propped up by aggressive accounting tricks, like recognizing revenue for a massive yearly contract before the service has actually been delivered month by month.
Right, because if I sell the business in June, the buyer has to deliver the rest of the year's service, but I already took all the cash in January. That makes sense. What else? I've heard the term black holes thrown around.
Black holes are hidden liabilities that might not be obvious on a standard year-end balance sheet, but will utterly destroy a deal when uncovered.
Like what kind of liability?
We're talking about unrecorded creditor debts. We're talking about incorrect pay tax setups. Maybe you've been misclassifying contractors who should actually be taxed as full-time employees. Or messy VAT compliance where you've been claiming back VAT on expenses you shouldn't have.
And if the buyer inherits the business, they inherit those tax liabilities. So if my generalist accountant missed that, the buyer's M&A team will absolutely find it and use it to slash the purchase price.
Exactly. Your M&A accountant's job is to anticipate these attacks before due diligence even begins. They find the black holes first, clean them up, and prepare the defenses.
Ensuring the numbers tell a clear, bulletproof story.
Exactly that.
Okay, so let's say we survive due diligence. The buyer agrees the business is worth £5 million, no black holes found. The hard part is over. Now, we just agree on a date to sign the check, right? Why does the accountant still need to be hovering around?
Because the headline purchase price of £5 million is practically an illusion.
An illusion.
Yes. Once due diligence confirms the numbers, the accountants must figure out exactly how the money will change hands. And that structure completely dictates your tax burden.
Wait, $5 million is $5 million. Are you saying the way the money moves changes how much of it I actually get to keep? Let's ditch the abstract. Give me a tangible way this goes wrong. I want to understand the mechanics of this.
Sure, let's look at a classic structural dilemma tax professionals call the Fred and Wilma scenario.
Okay, Fred and Wilma.
Let's say Wilma is selling her business to Fred. Fred doesn't have all the cash up front, so they agree to what's called deferred consideration. This means Wilma gets paid a portion of the purchase price over time out of the business's future profits.
That sounds normal. It's an earnout. I get paid as the business makes money.
It sounds normal until you look at the tax mechanics. That deferred money has to be funded by the business's profits post-corporation tax.
Okay, track with me.
So imagine the company makes £250,000 in profit. First, the company pays 25% corporation tax to the government. That leaves roughly $187,000.
Right.
Now, if Fred, the buyer, doesn't use a specific corporate structure and just takes that money out of the operating business to pay Wilma her deferred consideration, the government classifies that extraction as a personal dividend.
Oh, no. So Wilma is getting hit with personal dividend tax, which is nearly 40% for higher earners, on top of the corporation tax the business just paid.
Exactly. The money gets taxed heavily twice before it even reaches the seller. So that $5 million headline price shrinks drastically.
It's like trying to move money through hostile customs borders. Every time it crosses from a corporate entity to a personal entity, a massive tariff gets applied. So how does an M&A accountant stop that from happening?
They ensure the buyer uses a holding company to make the purchase. By having a holding company own the operating company, the profits can pass upwards between the two UK companies as a dividend.
And that avoids the tax.
Crucially, dividends passed between UK corporate entities do not trigger that massive personal dividend tax. The cash is preserved inside the holding company,
Oh, wow.
and then it can legally be used to pay your deferred consideration as a capital payment rather than an income payment.
So basically, if I try to DIY this and just accept the buyer's basic offer, I am voluntarily double taxing myself just to save a few grand on advisory fees. That is a massive blind spot.
The only number that matters is what safely lands and stays in your personal bank account after the tax man has his say.
Okay, so the holding company protects the money flowing out of the business over time. But once that money actually hits my personal hands, doesn't the government take a massive slice of capital gains anyway?
They do, yes.
Because I've heard rumors about this tax-saving tool for sellers in the UK. How do we protect the money at the finish line?
You're talking about Business Asset Disposal Relief, or BADR. It used to be called Entrepreneur's Relief. It is the absolute holy grail for a selling business owner.
The Holy Grail. I like the sound of that.
If you qualify, it allows you to pay a capital gains tax rate of just 10% instead of the normal 20% on up to £1 million in gains. Historically, it was even higher, up to $10 million.
Cutting the tax bill in half? That is incredible. But what does the accountant actually do? Don't I just check a box on my tax return at the end of the year?
It is far more complex than checking a box, and this is where a brilliant M&A accountant earns their fee 10 times over through structural magic.
Give me an example.
Let's say you have £500,000 of surplus cash just sitting in your business bank account. It's a rainy day fund. You haven't taken it out over the years because you didn't want to get crushed by income tax or dividend tax.
Right. If I take it out the day before I sell the business, the government taxes it as income. So I lose a huge chunk of it.
Exactly. But an M&A accountant can structure the sale and purchase agreement so that your own surplus cash is legally treated as the buyer's initial consideration payment to you.
Wait, let me make sure I'm grasping the mechanics of this. You're telling me my accountant can take the $500,000 sitting in my own business bank account right now, use it to fund the buyer's down payment to me, and instantly save me a fortune. How does a taxman allow that?
By structuring it as part of the share sale consideration, you are extracting your own cash as a capital receipt. Because it's part of the sale of the business, it falls under capital gains.
Oh, I see.
And specifically, it qualifies for that beautiful 10% BADR rate. If you had taken it out pre-sale as a normal dividend, you'd be paying top-tier income tax.
That is an unbelievable strategy. If it's that effective, why doesn't every general accountant just do this automatically?
Because generalist accountants often mistakenly think this strategy is illegal.
What, really?
Yeah. They confuse the strict financial assistance rules that govern public companies with the much more flexible rules that govern private companies. They get scared of the liability, advise you against it, and cost you hundreds of thousands of pounds.
Wow.
This proves, yet again, why you need a specialist to secure that 10% rate well before completion day. If the deal closes and you scramble to fix it afterwards, the relief is gone forever.
Okay, so the deal structure is locked in, BADR is secured, the money changes hands. After completion, is the M&A accountant finally done? Do we part ways?
Not quite. The post-completion phase is critical. After the deal is signed, your accountant still must file the final tax return for the sale, calculate the exact capital gains tax due to the penny, and ensure all the BADR claims are formally submitted to HMRC correctly.
So they stick around to make sure the paperwork actually reflects the strategy.
Yes. They also often work alongside wealth managers to advise you on how to handle the sudden influx of proceeds safely, ensuring you don't accidentally trigger new tax liabilities the moment you start investing your newly liquid wealth.
So it's end-to-end protection. Which brings me to my final and probably most important question regarding timeline. So what does this all mean for when I hire them?
Timeline is everything.
Because instinct tells me I should wait until the buyer, and I have agreed on the basic terms, sign the heads of terms, just to save some money on those expensive M&A accountant hourly fees before the deal is a sure thing.
That instinct to save a few £100s on early advice is the single biggest mistake sellers make, and it routinely costs them hundreds and thousands of pounds in irreversible tax mistakes.
Why? Heads of terms are just preliminary outlines. They aren't the final contract. Why can't we fix the structure after we sign them?
Because heads of terms almost always grant exclusivity to the buyer. You are locked in a room with them, legally speaking.
I hadn't thought of that.
If you wait until after the heads of terms are signed to bring in your M&A accountant, and they instantly spot that the Fred and Wilma deferred consideration problem is baked into the terms, or that you won't qualify for a BADR based on the agreed structure,
It's too late.
it is incredibly difficult and sometimes impossible to renegotiate.
Because the buyer knows I can't go talk to any other buyers. They hold all the leverage. I've trapped myself in a terrible tax structure just to save a week of accounting fees.
Precisely. The buyer will say, "We agreed on this structure, take it or leave it. You must involve your M&A specialist once you have a general outline of the deal, but absolutely, unequivocally, before you sign anything that grants exclusivity or defines the structure."
All right, I am stepping out of the role play now. Listener, let's bring this all together. What we've uncovered today is a core, practical reality.
Yeah.
Your accountant is arguably the most important person in your business sale.
Absolutely.
You simply cannot rely on the person who does your year-end taxes to navigate the hostile customs borders of M&A tax law. You must choose an M&A specialist, you must involve them before you sign heads of terms, and you must let them normalize your profits and tidy your financial records before the buyer ever gets a glimpse of them.
And if we connect this to the bigger picture, I want to leave you with a final lingering thought. Think about this scenario. When a buyer's M&A accountant looks at your books during due diligence, they are secretly hoping you used a generalist year-end accountant.
Wait, really? Why would they care who I use?
Because if you haven't normalized your profits to show true value, if your generalist hasn't proactively identified and fixed the black holes in your payee or VAT, or structured your assets properly for tax relief, the buyer's team knows they have the upper hand.
They can just pick you apart.
They know they can negotiate your life's work down to a bargain price, simply because your representation didn't know how to defend the value or structure the extraction. The ultimate question you have to ask yourself as you prepare to exit is this: whose accountant is going to control the narrative of your business?
It really all comes back to that opening thought. You wouldn't ask your trusted GP to perform brain surgery no matter how much you like them. When it comes to the life-changing event of selling your business, make sure you have the specialist surgeon in the room. Unpack your numbers, protect your cash, and don't let the tax man take the reward for your life's work.